Imagine waking up one morning and discovering that the bank you've trusted for decades no longer exists. Your retirement savings have shrunk overnight. Businesses are laying off workers by the thousands. Families are losing homes they thought they owned. And the scariest part? None of it happened because of a war. It didn't happen because people suddenly stopped working. It happened because millions of people believed one dangerous idea: that housing prices could never fall. One assumption, one massive illusion. And it triggered one of the worst financial disasters the world has ever seen. But here's what most documentaries never explain. The crash wasn't caused by one bad decision. It was caused by thousands of smart decisions that looked perfectly safe. Until they weren't. The dream everyone wanted. At the beginning of the 2000s, the economy needed a boost. To encourage spending, interest rates dropped to unusually low levels. Borrowing money suddenly became incredibly cheap. For millions of people, buying a home felt easier than ever before. Banks advertised mortgages everywhere. TV commercials celebrated homeownership. Friends talked about the money they were making from rising property prices. Owning a house wasn't just about having a place to live anymore. It became a symbol of success. If your neighbor bought a bigger house, you wanted one too. If your coworker made $80,000 selling a home, you started wondering if real estate was the easiest way to become wealthy. People weren't buying homes because they needed them. They were buying because they believed prices would keep climbing forever. And that's where the first mistake began. Easy money changes everything. Normally, banks are careful. They check your income, your savings, your debts, your ability to repay the loan. But during the housing boom, those rules slowly disappeared. Lenders became obsessed with one thing: making more loans. Because every new mortgage meant another commission, another bonus, another paycheck. Imagine a teacher earning $45,000 a year applying for a mortgage that should have been impossible to qualify for. Instead of saying no, the bank found a way to say yes. People with unstable jobs, poor credit, or very little savings were suddenly approved for enormous loans. Many borrowers didn't fully understand what they were signing. Some loans started with low monthly payments that later increased dramatically. Others delayed the real cost until years later. At first, everything looked affordable, but hidden beneath those attractive monthly payments was a financial time bomb: the illusion of endless wealth. As more people borrowed money, more people bought houses. As more houses were purchased, prices climbed even higher, and rising prices convinced even more people to buy. It became a cycle that fed itself. Imagine an auction where every new bidder pushes the price higher. Eventually, people stop asking what something is actually worth. They only care whether someone else will pay even more tomorrow. That's exactly what happened. Homes stopped being places to live. They became lottery tickets. Some buyers purchased second homes. Others bought third or fourth properties. Not because they planned to live there, but because they believed they could sell them quickly for an easy profit. The market rewarded almost everyone. At least, for a while. The dangerous assumption: every financial bubble depends on one belief. In the dot-com bubble, it was that internet companies would grow forever. In the housing bubble, it was even simpler: houses never lose value. That sentence sounded so reasonable. Almost nobody questioned it. Banks believed it. Investors believed it. Homebuyers believed it. Even experienced professionals repeated it as if it were a law of nature. But markets don't obey beliefs. They obey reality. And reality was quietly preparing a very different ending. Most people thought the story ended with banks making risky home loans. It didn't. That was only the beginning. The real danger started after the loans were approved. Because banks discovered something that completely changed the game. Instead of keeping mortgages for the next 30 years, they could sell them. Imagine owning a bakery. Normally, you bake bread and sell it to customers. Now imagine someone offers to buy every loaf the moment it comes out of the oven. Would you care as much about quality? Probably not. That's exactly what happened with mortgages. Banks no longer worried about whether borrowers could repay. Once the loan was signed, it became someone else's problem. And that changed everything, turning risk into a product. Wall Street gathered thousands of mortgages together. Good loans, bad loans, everything in between. Then they bundled them into giant investment packages and sold them to pension funds, banks, insurance companies, and investors around the world. On paper, it looked brilliant. One family might struggle to repay, but surely thousands of families couldn't fail at the same time, right? That assumption made these investments appear incredibly safe. Money poured in from every corner of the world. Investors believed they had found an investment that generated steady returns with very little risk. The demand became enormous, and when demand exploded, banks wanted even more mortgages to package and sell. The machine needed fuel, and that fuel was new borrowers when incentives go wrong. Here's something every investor should remember. People usually respond to incentives. If you reward speed, people move faster. If you reward sales, people sell more. And if you reward loan volume, people approve more loans. Whether they're good or bad, mortgage brokers were paid for closing deals, not for making sure those loans would survive for decades. The more signatures they collected, the bigger their paycheck became. Slowly, the goal shifted. It was no longer about making responsible loans. It was about making as many loans as possible. And when incentives reward the wrong behavior, problems grow quietly until they become impossible to ignore. The experts stopped asking questions. Something strange happens during every boom. When everyone is making money, very few people want to hear bad news. If someone warned that prices were too high, they were called negative. If someone questioned the risks, people laughed. After all, why listen to a pessimist when your house just gained another $50,000 in value? Success created overconfidence, and overconfidence blinded people to obvious warning signs. The louder the celebration became, the quieter common sense grew. A few people saw the storm. Not everyone believed the story. A small group of investors decided to look beyond the headlines. Instead of asking, "How much money can I make?" they asked, "What happens if everyone is wrong?" They studied the loans. They looked at repayment histories. They examined contracts that almost nobody else bothered to read. What they found shocked them. Many borrowers could barely afford the initial payments. If interest rates increased, or home prices stopped rising, millions of homeowners would face serious trouble. The entire system depended on one fragile assumption, that prices would always go higher. Remove that belief, and everything started to fall apart. The first cracks appear. At first, nothing dramatic happened. Just a few missed mortgage payments, a handful of foreclosures, one neighborhood where homes took longer to sell. Most people ignored it. After all, markets experience small setbacks all the time. But beneath the surface, pressure was building. More borrowers struggled to make payments. More homes entered the market. Fewer buyers appeared. And for the first time in years, home prices stopped climbing. That single change terrified the entire financial system. Because everything had been built on the belief that prices could only move in one direction. They didn't. They turned around. And once they started falling, the panic had only just begun. When the house of cards collapsed. For years, the system looked unstoppable. Banks were reporting record profits. Investors believed they had discovered the perfect investment. Homeowners felt richer every month. Everything looked healthy, until reality finally caught up. It started quietly. A homeowner missed a payment. Then another. Soon, thousands of adjustable-rate mortgages reset to much higher monthly payments. Families who had barely managed the original payment suddenly faced bills they couldn't afford. Some tried to refinance. The bank said no. Others tried to sell. But there was one problem. The buyers had disappeared. When prices started falling, as more homeowners rushed to sell, the number of houses on the market exploded. Too many sellers. Not enough buyers. Prices began falling. At first, only a little, then a little more. People who had borrowed almost the full value of their homes suddenly owed more than the homes were worth. Imagine buying a house for $400,000. A year later, it's worth $300,000. But you still owe the bank $390,000. Would you keep paying? Many people couldn't. Some chose to walk away. Others had no choice. Foreclosures spread across entire neighborhoods. Empty homes became a common sight. The shockwaves reached Wall Street. Now the real crisis began. Remember those mortgage investments that banks had sold around the world? They were losing value fast. Investors suddenly realized those safe investments weren't safe at all. No one knew what they were actually worth. And when people can't agree on the value of something, they stop buying it. Financial markets froze. Banks became afraid to lend money, even to other banks. Trust disappeared. And without trust, the financial system couldn't function. Imagine a city where every traffic light turns red at the same time. Nothing moves. That's what happened to the flow of money. Businesses couldn't get loans. Families couldn't borrow. Companies delayed hiring. Some couldn't even pay employees. The economy began to grind to a halt. The fall of a giant. Then came the moment that changed everything. One of the oldest investment banks in America, a company that had survived wars, economic downturns, and more than a century of financial history, ran out of options. Its losses had become too large. Its confidence was gone, and no one wanted to rescue it. When it collapsed, the message spread across the world in hours. If a financial giant could fail, who was safe? Fear spread faster than facts. Investors sold almost everything. Stock markets plunged. Companies canceled expansion plans. Consumers stopped spending. Businesses started laying off workers. The financial crisis had become an economic crisis. The cost paid by ordinary people. Here's what many people misunderstand. The biggest victims weren't the executives in expensive offices. They were ordinary families. Parents lost jobs they had held for decades. College savings disappeared. Retirement accounts shrank dramatically. Small business owners watched customers vanish. Young graduates entered one of the toughest job markets in modern history. Millions of people who had never owned risky investments still paid the price. Because when credit stops flowing, the entire economy feels it. Restaurants lose customers. Factories reduce production. Construction projects stop. Local businesses close. One financial mistake spread through every part of society. It was like knocking over the first domino and watching thousands more fall. The turning point. Governments and central banks faced an impossible decision. Do nothing and risk a complete collapse of the financial system. Or step in, using enormous amounts of public money to stabilize the economy. They chose to act. Emergency rescue programs were launched. Interest rates were cut dramatically. Financial institutions received support to prevent an even deeper crisis. The immediate panic slowly faded. Markets eventually recovered. But the damage left lasting scars. Millions of families spent years rebuilding their finances. And one lesson became impossible to ignore. A booming market can hide enormous risks. The most dangerous bubbles don't look dangerous. They look normal. The lesson every investor should remember. The economy eventually recovered. The stock market climbed again. New companies were created. Businesses reopened. But something had changed forever. People realized that the biggest financial risks rarely announce themselves. They usually arrive wearing a disguise. They look safe. They look profitable. They look like opportunities everyone is chasing. That's why every major financial crisis follows a familiar pattern. First comes excitement, then confidence, then greed, then the belief that this time is different. And finally, reality arrives. The biggest mistake wasn't borrowing. Most people believe the 2008 crisis happened because people borrowed too much money. That was only part of the story. The deeper problem was something far more dangerous. People stopped asking difficult questions. They trusted rising prices more than basic mathematics. They assumed the future would always look like the recent past. History proves otherwise. Markets move in cycles. Booms create confidence. Confidence creates risk-taking. Too much risk creates bubbles. And bubbles eventually burst. The asset changes. The pattern doesn't. Why this still matters today? You might think this story is just history. It isn't. The names of the investments may change. The technology may change. The headlines may change. But human behavior stays remarkably similar. Whenever you hear someone say, "You can't lose. Everyone is making money. This investment only goes up." Take a step back. Ask questions. Understand what you're buying. Never invest simply because everyone else is doing it. The crowd is often most confident, right before reality proves it wrong. The rules that can protect you. If there's one positive outcome from the crisis, it's the lessons it left behind. Here are 4 principles that every investor should remember. First, never borrow money you don't fully understand. If an investment or loan can't be explained in simple language, walk away. Confusion is expensive. Second, don't mistake rising prices for real value. Something isn't a good investment just because it's becoming more expensive. Always ask what it's actually worth. Third, diversify. Never allow your financial future to depend on a single investment, a single company, or a single market. The strongest portfolios are built to survive uncertainty. And finally, think long-term. Wealth isn't built by chasing every trend. It's built through patience, discipline, continuous learning, and smart decisions repeated over many years. Slow progress often beats fast mistakes. Closing. The financial crisis of 2008 wasn't just about banks. It wasn't just about mortgages. It was a lesson about human nature. When fear disappears, greed grows. When everyone believes prices can only rise, risk quietly multiplies. And when nobody questions the system, even small cracks can bring down enormous institutions. The next financial crisis won't look exactly like 2008. It never does. But it will almost certainly begin with the same dangerous belief that this time, the rules no longer apply. The smartest investors aren't the ones who predict every crash. They're the ones who prepare for uncertainty before everyone else sees it. Because protecting your money is just as important as growing it. If you enjoyed this breakdown and want to learn how money, investing, and the economy really work, subscribe now. Every week, we break down complex financial topics into simple lessons that can help you make smarter financial decisions before everyone else does.